So, it is really important that if you're doing this job, even if it's part-time, uh, you do it right and have some of these resources at your fingertips. Now, you can go to a place called Credit Advisors, for instance, a nonprofit. They've been in business for over 50 years. They have relationships with all of the big lenders already, already predetermined relationships. So if somebody qualifies for the program, then they will get their debt reduced to the lowest possible rung possible, lowest rung possible. And I'm sure there's certain tiers based on, how much of a hardship. They definitely go over your hardship with you. But the nice thing about these kind of people is that they can get this debt down today or in the next 2 or 3 days. They're out there, out in the market right now. There are so many people that claim they will help to reduce credit card debt, all right? But what their ultimate goal and what they're ultimately doing is to basically run your credit down into the tubes, into the toilet, not pay the debt, not pay the debt, not pay the debt, and then after a period of a couple of years, once the lenders have put this into, have written this debt off, the idea is right at or around the time that debt is written off to mediate with them and try and get a lowering of that debt to 10, 15, 20 cents on the dollar. I would not at all recommend those kind of credit card debt reduction programs if you're trying to do a loan modification, or if you are qualified by having Fannie Mae or Freddie Mac as a lender. I absolutely would not. If you want to stay in your home, don't do it, because it's not going to get fixed in time for you. You need this done immediately. And the nice thing about these kind of credit card advisors is that they will fix it that day. And so that on your report, now you can truthfully and honestly say, okay, I went to credit card advisors today, and this is what they said, and they lowered my debt down to this, and you can show them a little statement of that, and you can update your financials that day on the spot, and then suddenly qualify for a loan modification when you did not qualify at all the day before, and the person you were talking to had no idea why. So, these are the kinds of things that are important, and as a loss mitigator, you really need to learn these as well. So, 5, your proposed workout should equal 31% of your debt, of your front end debt. And that's the workout for your first mortgage loan, not for subsequent mortgage loans. So, you may actually really be in trouble, and you may never be able to get a proper loan modification, because a lot of when people had a low first and second, they were paying it off, and then they got refinanced with a higher line of credit or whatever. I've seen this happen quite a bit, where the line of credit's $200,000, the first is $100,000, and the second's $50,000 or $60,000 or $30,000, $20,000. So, in those kind of circumstances, you may have a very difficult time with getting an actual loan modification, because particularly the Home Affordable Modification Program doesn't deal well with the seconds and the thirds. They won't reduce it much more than 6%, and that would be if it's higher than $100,000, or its cap is $6,000. So basically $100,000 of debt, you get a $6,000 write-off. Otherwise, it's going to be less. So that's all they'll do on that per lender. So that's something that is something to think with when you're trying to get a loan modified, when you're trying to keep the person in the home. There might need to be some sort of an alternative workout program, or the person certainly might have to go to each lender and get their loans modified and get that lender to accept different terms. 6, after you deduct all of your non-discretionary expenses from the financial form that you filled out, and you just have a clean, you have rather you deduct only the discretionary expenses. What you want to have is a plus at the end. After all your expenses were deducted from your income, except for discretionary expenses, you want to see what what those funds are, and that should be at the very bottom line. That's where Starbucks comes in, movies, vacations, things like that. Those are all discretionary. And the rule on discretionary funds is basically $300 to $500. That's a sort of a loose rule of thumb that I've heard from some, and roughly I've seen that pan out from loan mud to loan mud. So if you add truly discretionary funds onto the form, though, you could end up with lenders seeing all this oddball stuff, and then they discard that form altogether, and they just rely on your debt front end and back end debt to income calculations only. Sometimes that can be beneficial, but if you have a income property or you have extraordinary expenses on your regular financial form, then take the time to fill that out carefully with an eye for separating out those discretionary funds. Now, lending and underwriting isn't an exact science, but keep the recommendations in mind that I'm saying. 7, if your balance is too low in order to do a workout after your expenses, you're going to need to do a proposed workout in order to give that to the underlying investor. Let's say your expenses are minus, your plus and minus ends up with a minus $1,000, which I've seen a lot. Basically, minus $1,000, that's impossible, obviously. You're not paying, well, it's not actually impossible, quite honestly, because somebody could have, I've heard of people going gambling to get the money to pay their loan. And they were relatively successful, but not always predictable. I've also heard of people selling other assets, getting rid of savings accounts, and all of this, bringing things down to practically nothing in order to qualify. And that, of course, really would put you in a valid minus on that form. But what I would highly recommend when you're doing this financial form is, if you end up at the bottom with a minus, you're less than $300 discretionary funds, because you've got so many expenses, so many loan expenses, and none of these are from income property. They're all just from your first mortgage and essential credit cards or auto, that type of thing, insurance, other expenses like that. Then basically what I recommend is then you do a kind of mock workout on the financial form yourself. That way you can start pulling the interest rate gradiently, point by point, down to 6%, or rather, I'm sorry, not 6%, down to 2%, and then you'll stretch out gradiently year by year the term of your note out to 40 years, and then once you've done that, then pull the principal down and see what it is actually going to take for your specific circumstances in order for a lender to do it according to the book. All right, now, whether or not the lender does it according to the book, well, we all know, I already know for sure that, frankly, better than 50% of the time, they don't do it by the book. But at least then you would have something conversational to go over with them. Well, hey, the Home Affordable Modification Program guidelines say this, why are you different than that, and what system are you using?